Have you ever wondered why you need a really good property accountant as a property developer? Well, over the next 30 minutes on today's Open Door Show, I'm going to be talking to Penelope Walters from Trimantic Accountants. She is an expert property accountant, and we're going to hear all about why that's important. Hello there, and welcome to the Open Door Show from propertyCEO. My name is Ritchie Clapson, and I've been involved in property development now for over 40 years, and I've co-founded the training company propertyCEO, which teaches people how to develop property. And yes, look, on today's show, we're going to be taking a deep dive into the world of property accountancy. And I'm really pleased on today's show, we've got the wonderful Penelope Walters from Trimantic Accountants. Penelope, hello there.
Hello, Ritchie. Good to be here.
How are you? Well?
Yeah, very good, very good. A bit depressed following the budget yesterday, but, sort of soldiering on.
Soldiering on. Well, maybe we'll pick up the budget in a minute. But look, it's really good to have Penelope here with us today. I've been trying for quite a while to get her on the show, but she's super busy. But we're going to be talking to you out there as property developers. We're going to pick up some of the budget stuff. We're not going to really talk about buy-to-lets and that sort of thing and being landlords, but we're going to focus on being a property developer. But first of all, Trimantic Accountants, where are you based? Tell me a bit about the business, Penelope.
Okay, so I'm a chartered accountant, have been so for over 2 decades. I specialise in property accounting. We're based in Hertfordshire, in St Albans, but to be honest, most of what we do is online now. I mean, that's the beauty of COVID, of course, is that it's now, this kind of interaction has become the norm. So we do most of our meetings like this these days.
Cool, good. So, and what sort of customers do you serve? You cover all
sectors? So we have all sorts. Yeah. So as I say, our specialty is property investors. We cover all sorts. The one which I most enjoy is entrepreneurs who are just starting out. So people who know that they really want to do something, and doing the kind of courses that you offer, which gives them that information to be able to actually take it forward, perhaps lacking the tax and accountancy knowledge. And so just being part of their journey is stuff that I really enjoy. So that's the kind of clients that we have and that we really enjoy working with.
Great stuff. Let's get stuck straight into it. I've got a stack of questions. I don't know how many we're going to get through, but I really want to draw out, Penelope, some of the important things that I know our listeners want to hear. And one of the ones, the first question is about the structure of a development company. Because one thing I always say to people, get yourself a property accountant, because not all accountants are equal. I'm not saying other accountants aren't good what they do, but we need to understand property. And one of the first things we need to do is get our structure right. How should we set up a property company? Is it group holding companies and individual companies? Could you just explain that for us, please?
First of all, you make a really good point about the need to have a property accountant. I always say this to people, is that it's no shame to other accountants who don't have expertise in that area. When you go to your GP and you say, I've got a problem with my heart or my knee or whatever, they don't try and fix it if it's outside their area of expertise. The first thing that they do is they send you off to a specialist. And so I think that, high street accountants who are used to doing, self-assessment, small business accounts shouldn't feel any shame to refer people on to a property accountant, because tax law is incredibly vast, it's incredibly specialist, and you can't know everything about everything. So that's the first thing. I definitely agree with you in that regard. In terms of a property structure, you can do it in your own name. It's a terrible idea to do so, because property development, unlike being a landlord, it's considered a trade, which means that it's subject to income tax in the same as all of your other incomes, which means you could end up paying up to 45% income tax plus national insurance of between 2 and 6% as well. But the worst part about doing it in your own name is it means that all of your personal assets are at risk. So we tend to rule that one out. You can do it through a partnership. LLPs have become quite trendy recently. An LLP, it does give you the protection from a liability perspective. However,
what does LLP stand for, Penelope? LLP, what does it stand for, those that wouldn't know?
So an LLP is a limited liability partnership. So it's registered with Companies House. You have certain reporting obligations, but you do get protection. So if it all goes horribly wrong, then your own personal assets are protected. However, partnerships of all shapes and sizes are transparent for tax purposes. What that means is that your part of the partnership income is taxed on you in the same way as if you were earning it in your own right. So what we recommend is a limited company structure, a pyramid structure, where you have a parent company that holds the shares in the SPVs, known as a special purpose vehicle, which is basically a limited company which is set up specifically to do a specific type of work. So in this case, it would be development. So the SPVs, the subsidiaries, they would purchase the building or the land initially, and then carry out the development project. Once the development project is finished, they then sell the leases in the flats that they've created, and then once that's all done, they've realized their profit, they would then transfer the freehold up to the parent company, which then holds that asset.
If you want to sell the freehold on, you could just sell the freehold on if you want to get rid of the whole lot.
Exactly. But the beauty of transferring it to the parent company and having separate limited companies for each of your development projects is that, let's be honest, development projects, they can be risky. If you get it wrong, if you get your budgets wrong, if you have a bad builder, there's things that can go wrong with it. And so you want each project, the liability and the risk associated with each one, to be contained within its own individual company. So if you were, particularly ambitious and wanted to do 3 projects at the same time, each one in an individual company, and then that way each one has its own risk, and it is the rest of the group and the rest of the assets are protected in the event that it went wrong.
Yeah, I think that's massively important. That risk structure, I think, is hugely important. The other thing to add to it as well is that the commercial funders are going to want a clean company to invest in every time. So regardless of the great advice that Penelope is giving us here of how we set this structure up, your funder is going to want a clean company to invest in. Let's just think on this investing line. So we've obviously got our commercial investors that are investing into this company, and that structure works for them. But we're also going to potentially have private investors putting money into development deals, which is really how we structure things. If you don't know about that, hold that thought. I'll give you a link and you can come and join us for some further training to understand that. But Penelope, private investors, how do we handle those in development?
That's very interesting, and that's something that comes up quite a lot. Now, the first thing to say is that there's 2 main forms of ways that people can invest in your development project. The first is equity, is basically having shares in the development company, so in the SPV that's doing the development. So they could take equity. However, we don't recommend that. We recommend, wherever possible, so the investment to take the form of a loan. So with a loan, the investor puts their money in, and then they get a rate of interest on the loan for as long as it's outstanding. If they are part of the equity of the business, and some investors might insist that they are part of that, because of being an equity investor mean that they participate more in the upside. The one thing that people very much have to be mindful of is that within the group structure, there has to be 75% ownership for assets to be able to be transferred around the group without incurring stamp duty. So that's really important. Now, a 75% group means that one company owns at least 75% of the share capital of another, or that 2 companies are both owned 75% by a third company. So this 75% group is really, really important. If you have your investor and they insist on 40%, then you're going to fall foul of that 75% group, and then you won't be able to transfer assets around free of stamp duty. That's really, really important. So if at all possible, we definitely recommend offering people the loan finance option.
And in terms of that, obviously, if we are going back to this point, Penelope, where we might just sell all of the assets on, we don't need to move them around the group. Does that rule still apply or not? Is that more flexible?
Yeah, so it doesn't. I mean, if you're planning to do everything within the one SPV, so if you're planning on literally just doing your development project and selling them on, your outside investor is part of that company. So whatever profits that you realize, they get their part, you get your part, and then you can close it down. Then the 75% group doesn't become an issue because you're not moving anything within the group. It's only that if you want to move assets around the group, or if you want to share losses with around the group. So if one of your projects is making losses and another one's making profits, you want to offset one against the other, you need this 75%. But if you're doing it all as a standalone activity, no, there's no requirement at all.
Brilliant. That's really good. I think you've explained that really well. And I think that's a big thing a lot of people get stuck with is how do I sort these private investors out? And generally, you say on a loan note type arrangement. You touched on stamp duty, land tax. Now, we're actually recording this the day after the budget. So a lot of you will be listening to this at a different time. You could, and the budget, by the way, in October 2024, because this could be you're listening to this show in 25 or 26. There was a recording. But we had the budget yesterday, Labour's first budget for many, many years. Stamp duty, land tax was talked about in there. What were the implications of what's discussed there in terms of property developers and how they may or may not pay more tax?
This is quite interesting because whilst they increase the rate of stamp duty is paid when you purchase a property. And limited companies, as well as people owning a second home, will always pay the surcharge, and the surcharge is increased. So now for residential property, the top rate of stamp duty has now gone up to 17%. That's 17%. Now compare that to the commercial rate of stamp duty, where the top rate is just 5%. So that got me thinking, obviously planning to come on this show, and it got me thinking about this. If you are looking to ultimately become a buy-to-let investor, so that at the moment you've got lots of energy and enthusiasm and you're looking to do development projects, but long term, perhaps when you retire, you're looking for more sort of regular income, less stressful income, and you're looking to build a buy-to-let portfolio, it would actually be a lot cheaper to create your own buy-to-let properties by doing a development and just keeping them rather than actually buying a buy-to-let properties on the open market, because you buy your property, your commercial property, paying maximum 5%. You convert it into a number of units. You would have to then transfer those to a new limited company, which then becomes your buy-to-let company. But you've avoided paying up to 17% stamp duty on those purchases. So there are much great opportunities there to make stamp duty savings. It is complicated. And again, touching back on your original point of you do need to make sure that you're doing things in the right way. Because if you were to, convert your properties into smaller flats and then hold on to them and let them out, you're not then making a supply of new properties, and therefore it's not zero rated for that. So, it is complicated, but if you get things right, there is great opportunities there to save a lot of stamp duty in the long run.
So in a way, the budget, albeit for second homeowners and simple buy-to-let landlords that are buying residential properties, are getting stung with more money. As a developer, if you want to build to rent some of these, to hold some of these, by carefully moving them around in this group structure and pre-thinking this, we're going to save ourselves a whole load of stamp duty, land tax.
Absolutely. So one of the first questions that I ask people when they come to me is, what is your long-term goal? What are you planning to do? So very often people ask me questions, and that's not the answer to that question is not what I need to tell them. So the first question I ask is, what is it you're trying to do? If you are trying to do a development now, but actually long term, you plan to go and lay on a beach in Marbella for the rest of your retirement, and you want to have properties to do that, then we need to be thinking, in terms of a structure that's going to allow them to do that, because they might be thinking in their heads, I'm going to make 200,000 by doing a development, and then I'm going to use that to then buy flats, which I can then rent out. But if you structure it more cleverly, do a bit of long-term planning, then actually you can get a much greater return and achieve your goals far quickly.
Wow, really important. Look, tax, one of the biggest tax of all is VAT. It's hugely complex as a subject. I don't intend to try and cover it today. So if you're listening to this, if you want to really understand VAT, you're going to have to reach out to your property accountant. But can you just give us a bit of an overview, Penelope, today on a few things around VAT which people get wrong, where it's zero rated, where it isn't? Could you just give us a bit of overview, please?
Okay, so VAT, the key thing here is that VAT and whether or not you can reclaim the input VAT and whether or not you need to be charged that very much depends on the nature of the supplies being made. That means, what is it that you are then, or your business is supplying? So if you are developing properties on greenfield sites, so i.e. land which has never been built on before, then that is zero rated. If you're doing a development, the kind of developments that your sort of tutees would be doing, building on brownfield sites, then their input VAT, so their builder's cost, will be subject to a reduced rate of 5% VAT. So there's lots of criteria that they have to meet in order for that to be the case. So it needs to be a conversion of a non-residential building into dwellings. So, non-residential building, could be an office block, it could be a pub, It could be a shop, something like that. And a dwelling is something that is somewhere that somebody would live. So, and again, not to go into too much of the, of the detail, but, things like a timeshare or a holiday home where you're only actually entitled to live there for 2 weeks a year wouldn't fall into the category of a dwelling. So interestingly, not only are we converting non-residential into dwellings, but also if you're changing the number of dwellings. So if you had a house that you're converting into multiple dwellings as well. So conversions are quite good for that, because you'll just be paying 5%. So one thing that people need to think about, and you mentioned just before the show, the top mistakes that people make is that you need to be very much on the ball with how much your builder is charging you for VAT and whether or not they're applying the correct rate. Some things are standard rating for VAT. If you went down to your local home base to buy wood or other materials, you'll pay 20%. If your builder is doing, the conversion work for you and they meet the criteria, it should be 5%. Some items, like carpet, bizarrely, are standard rated for VAT. I could never quite get my head around this one.
Even if the builder supplies the carpet, it's still standard rated.
Carpet is standard rated, yes. So bizarrely, tiles are not. Carpet is.
Is that roof tiles or floor tiles?
No, floor tiles. So floor tiles are fine. Carpet isn't. There's other things as well, like sort of your kitchen units, fine. Your fridge and your washing machine, standard rated. So this is where you really do need a property accountant who understands this detail, and you yourself as a developer or the person, the project manager that you've got running this for you, needs to be on top of those bills, because HMRC are very clear about this. If you're doing development work that's eligible for the 5% and you've been charged 20%, they will only refund the 5% that you should have been charged, not the 20% that you were charged.
Wow. So you'd end up being charged paying that VAT, but never been able to claim it back because you or your property accountant did not understand, or your accountant, because the property one would, but your accountant didn't understand the rules.
Exactly. There is one more thing as well, which is really, really important. So in order to be able to claim back the VAT when you're doing your development project, the supply that you're making needs to be 0 rated for VAT, which means that it needs to be the first sale of these newly created dwellings. So if you're selling a property which is already considered a dwelling, it's exempt, which means you can't reclaim the input VAT. If it's 0 rated or standard rated, but standard rated is not going to help us. If it's 0 rated, then you can reclaim the input VAT. But there is another criteria that you need to be aware of as well. And this is where the group structure, you need to get the group structure right. You need to make sure that you're doing things in the right order. So in order to be able to charge 0% VAT on your sales and reclaim all your input VAT, you need to have what's considered to be person converting status. It's an HMRC term. So person converting status means that you are a developer, basically, who's done the development and who's making a sale of these new dwellings.
Mm.
If you've done things in the wrong order, so your development company has done all the development, incurred all the costs, and then is ready to sell those properties, but then transfers it to your holding company first, your holding company doesn't have person converting status because it didn't do the conversion.
Yeah.
When it then makes a sale of those properties, they are then exempt. They're not 0 rated. Therefore, you can't claim back the VAT. So it's really important that your subsidiary, your development company, does the development with its person converting status, gets its input VAT right, sells its property, sells its newly created dwellings on, and then transfers it to the parent company. So there's a few things that you need to make sure that you're getting right in order to benefit from VAT in this situation.
Just going back to these carpet tiles, white goods and stuff, which some of it's at full rate, some of it's at 5%. What happens here if the builder, the contractor, charges you 5% on everything and he doesn't charge you 20% on the white goods that maybe he should have done? Is that now his problem?
Yeah, so if he's charging you the wrong rate of VAT, then that's on him. Yeah. So if so it's up to you as a person making the supply to get the VAT right. So because he will then, if he should have charged you 20%, but he only charged you 5%, he's still liable to HMRC for the 20% that he should have charged you. So whilst it's morally questionable not to draw it to his attention if he's charged you the wrong rate, by the letter of the law, it's ultimately his or her responsibility to get that right as well. And as it is yours, if he or she charges you the wrong amount and then you just go ahead and pay it, that's on you.
Now, this is massively complicated, and I'm sure many people listening to this, your heads are spinning, aren't they? You're thinking, what? Trying to make notes. The bottom line with this, and something I always say to people, is it's not trying to learn this stuff yourself. It's that wonderful phrase I always have, which is, who do I need, not how do I do it? This is stuff that you sort out for developers, isn't it? We need to know the broad understanding, but you will guide and steer us on this. Is that correct?
Yeah, exactly. So that's what your accountant's there for. So I always say it's really, really important to keep your accountant informed of what you're doing. So, and this is why, that's where the relationship, your accountant is there to support you, is there to advise you, but their advice is only as good as the information you're providing them with. If you've gone ahead and, you've transferred your completed project to your parent company, and then you as the accountant have got all this information, you're putting your VAT returns in because you didn't know they'd done this, then you could get it all horribly wrong without even realizing. So it's really important to keep your accountant informed of what you're doing and when you're doing it. You should be asking these questions. You should be saying, I'm looking to do this. I always tell people, look, tell me if you've got anything going on which you may or may not think is relevant. If it isn't, I say, okay, fair enough. No further action required, but it might be, the number of times, somebody said to me, my car, it's a nightmare just having a little chat. And I'm saying, well, you've got a limited company. If you're not considered getting an electric vehicle through the limited company, they're like, oh, I never thought of that. I was like, well, I wouldn't have ever thought to tell you had I not heard you complaining about your car that had just broken down? So you must keep your accountant informed so that they can then keep you properly advised.
Love it. I love it. What about one thing I really wanted to pick up before we finish today was CIS, okay, construction industry scheme, because in lots of ways, in the way we teach, it's really simple. If you do what we tell you to do, which is fixed price lump sum with a main contractor. But there are some, again, complicated descriptions of it where a lot of developers wouldn't think it's relevant to them. It's really something your accountant can just deal with. But could you, Penelope, just explain CIS?
Right, so CIS is the construction industry scheme. It's basically something that applies to the building industry. And the background to it is that, builders, particularly sort of small scale builders, are not necessarily the best at doing their tax returns and keeping their records and everything else. So as a way to combat that, HMRC introduced the construction industry scheme, which puts the onus on the person paying them to deduct tax, pay it to HMRC, so that when the builder then does their tax return at the end of the year and works out how much tax that they have to pay, most of their tax is already paid through being deducted from the payments you're making to them. Now, this doesn't apply to individuals having work done on their own home. So you don't have to worry if you're planning on doing an extension to your own home. That's, this is not who this is aimed at. This is aimed at what's called contractors, who imply subcontractors. So if you're a builder and you then hire a bricklayer or a plasterer or something else like that, the onus is on you to check that they're registered for the construction industry scheme and to deduct these amounts and then pay them to HMRC. If you are a property developer, you fall within that category. You are considered to be a contractor within the scope of CIS. It's a huge pain because it does mean that if you're not engaging with a main builder like you recommend, you are going to have to deal with each one of these individual, sort of tradespeople and make those deductions. It's a huge faff. So because your accountant will do the CIS return for you, but you're going to need to remember to make those deductions. So if you hire a bricklayer who's just going to come and do a day's work and they hand you a handwritten receipt at the end of the day, which is perfectly acceptable, and ask for cash or an immediate payment, you're going to have to work that out yourself before you pay them. So as you say, if you engage with one builder, and if they're sort of quite established, they're likely to have what's called gross status, which means that HMRC have deemed them to be suitably well behaved, not to have deductions made from them. All you have to do then is one monthly return where you declare how much you've paid to this one builder. So CIS is something that does catch people out because not many developers would consider themselves to be caught by this. But it does need to be done. And in the event that HMRC end up out of pocket as a result of, your builders not paying their taxes, they will come after you. And if you've not registered when you should have, there are fines for doing that. So CIS, if you haven't thought about it and you're doing a property development, you need to think pretty quickly.
And again, this is the benefit of having a property accountant, because you go to a property accountant, this is the early suite of questions they're going to ask you. They're going to talk about registration for CIS. A non-property accountant wouldn't know that, would they? They probably wouldn't even think about it.
Yeah, exactly. It's one of those things is that if you know about it, it's actually quite straightforward. If you don't, then you could end up in trouble.
Yeah. Another reason why, as I say to all of my students, work on a fixed price lump sum. Not only does it solve all these problems, and literally that issues now for your accountant just to do that simple return every month with no deductions if your contractor's gross status, but it just keeps everything in control and minimal risk. Look, we've covered a huge amount. We've talked about in a half hour today's show, we talked about group structures, bringing investors in. We've talked about stamp duty and what happened in the budget. We've talked about VAT, hugely complicated, and we sort of rounded up on CIS. Penelope, I think that's all we've got time for today. And I know we could sit and talk for another hour or 2 hours. Trimantic Accountants, how do people get hold of you if they like what they hear?
So quickest way to get hold of me is to drop me an email. So it's penelope@trimantic.co.uk. If you want to go to the website, then you can find more information about the services that we offer landlords, and as well as my contact details, which is trimantic.co.uk. We do offer people a free 20-minute sort of consultation initially. So if you're not sure if you need an accountant yet, or you're just thinking about getting started, but you're not quite ready to engage with somebody, then reach out to me, and I'm sure we can set something up, and that's at trimantic.co.uk.
And I reckon if you actually said that you saw Penelope on the Property CEO Open Door Show, you might get 25 minutes. You never know. Never know. Penelope, look, I really appreciate it. I know you're very, very busy, super busy. I know, working with a number of Property CEO students. I get great feedback about you. So look, absolutely appreciate you coming on today's show, and I look forward to catching up with you very soon. Thank you very much.
Thank you very much.
Well, folks, hopefully you enjoyed that. That was good, wasn't it? I mean, a lot of detail there, particularly the VAT, and it's hugely complex. And hopefully you can see why I tell you, you've got to have a property accountant. And Trimantic, reach out to them, trimantic.co.uk, reach out to Penelope Walters and the team. I'm sure they can help you. Now, if you are interested, if you're just dipping your toe in the water, grab a pen and paper, write this down, propertyceo.co.uk/SFR. SFR, six-figure roadmap, that stands for. propertyceo.co.uk/SFR, six-figure roadmap, will give you a bit of free training. I'm also going to put that in the show notes, and I'll put Penelope's details in the show notes. Please do reach out to her. Say you saw her here on the show, and you never know, you might get that extra 5 minutes. Thanks for listening, and we'll see you all soon. Thanks now. Bye-bye.